Hello everyone, welcome to today's US Open live webinar. It is Tuesday, September the 12th, 10 minutes before Wall Street opens. As always, I'm your host, Nikos Tsabouras, Senior Financial Editorial Writer at FXCM. The week started in a dramatic way as Bank of Japan Governor Ueda made hawkish remarks, unlike to what we had seen so far by him, that sparked significant market moves on Monday. And we also expect key events later this week and the next. Today we got another hot employment report from the UK, but the GBP fails to benefit, and Wall Street made a strong start to the week, but is subdued today. This is what we will be talking about today. But before we begin, as always, please read carefully through the risk warnings and the disclaimers, and then we will go ahead. Okay, let's get the ball rolling. We're gonna start off as usual with Euro USD. Then we're gonna talk about the USD versus the yen and the moves we saw there after the BOJ remarks that we talked about. Then we're gonna cover the British pound versus the US dollar in light of the key upcoming policy decisions and today's strong wage growth from the UK once more. And we're gonna round things off with the Nasdaq and what's ahead. We have key events coming up. We're gonna cover them towards the end of this session. Now, on the Euro USD front, we can see that the pair is subdued ahead of US CPI tomorrow, an ECB pivotal decision on Thursday. As I said, we're gonna cover them at the end, which will likely determine its trajectory. And of course, the Fed follows the next week. The pair trades below its 200 days EMA, essentially for the first time this year. You can see here we have repeatedly shown the daily chart, so you can see here that it's been well below the 200 days EMA for many days, and that's essentially a first for this year. You can see how it has been always above, barring some breaches above this line. And it is exposed to another crucial level, 1.0634, 1.0611, which could open the door to further losses. Baseline, of course, as I said, we expect these key events which could spark volatility and determine the next leg of the pair. Baseline forecasts for the Fed are for a hold, for the ECB, sorry, for the European Central Bank are for a hold tomorrow, but there is uncertainty in the way things have shaped. A continuation of the tightening cycle would constitute a surprise and could potentially lift the common currency. Even if it retakes the 200 days exponential moving average, the descending trend line from this year highs and the 200 period EMA, the black line, which are found at mid 1.08, still pose another challenge. And after that, we still have more road blocks, so definitely an unfriendly environment, the upside for the common currency. Now let's go to USD JPY, which dropped on Monday. Monday is the highlighted rectangle on your screen. After a hawkish interview by the Bank of Japan Governor, Mr. Ueda, who opened the door to an eventual rate hike if policymakers are confident that the 2% target inflation is achieved sustainably, and offered a rough roadmap that they could have enough data that would allow such a move by the end of the year. Of course, let me remind you that the Bank of Japan has negative rates and ultra loose policy setting with yield curve control, and in stark contrast, of course, with its major counterparts, the Fed included. So after these remarks, we saw a drop, and there is risk for further pullback, especially since we're still at the levels that had sparked the FX intervention exactly a year ago by the Japanese authorities, and this level is the dust line that you see on the chart, as we talked about before. And there is risk for deeper pullback that would test the 200-period EMA at around 145.10, but sustained weakness looks like a tall order daily close below that level would definitely be needed in a technical front. Of course, as we said, we have key events coming up. Tomorrow we have the US CPI inflation, and then next week both the Fed and the BOJ announce their latest policy decisions. Now, despite the hawkish remarks, and they did mark a significant turning point since Governor Ueda had not shown any inclination to depart from this ultra dovish stance, but there's no any imminent change suggested by him, and it does look like once again it's trying to gain some time, same way it did in July when they widened the yield curve control. So given those factors, we see a bounce, bulls regaining their composure, and the bullish bias remains intact as long as we are above the 200-period EMA, the black line on your chart. And the road is open for new 2023 highs towards 148.83, but we are cautious at this stage around further gains, given again critical events that we expect over the following days. Now let's go to the British pound. It remains in a precarious state, unable to elicit support from another hot UK wage growth report. Average earnings, including bonuses, increased further to 8.5% on the May-July period. Historically high wage growth, which keeps pressure for more hikes by the BOE ahead of next week's decision. One more central bank that announces its latest policy decision next week. As we have said before, the pound can't feed from this theme, can't get a boost from this theme to the extent that it had up until now, because there's already a massive amount of tightening, and each hike increases risk of more of potentially a mortgage crisis and further economic pain in general. Also, as we talked about last week, Governor Bailey essentially hinted that the BOE could soon reach peak rates, and all of the above weigh on the British pound. It tests for a few days now the critical support provided by the 200 days EMA and the 50% Fibonacci of the 2020 low, 2023 high advance, and there is risk of further losses towards 1.2307. On the other hand, it shows resilience around that critical region, and this could give it a chance to bounce, but strong catalyst will be required for tackling the 200-period EMA, the black line at around 1.2650. And once again, we have an unfriendly and unhospitable upside from that point on. And let's switch gears and go to the Nasdaq just as the US session gets underway. It made a strong start to the week on tech optimism, and having defended the 200-period EMA during last week's decline, the bullish bias is still in place, and there is still good chances for new 2023 highs located at 15,946, but again the record highs at 16,770 are quite high for now. On the other hand, we see that it turns cautious again today, and contained by the upper border of the daily smoke cloud, there is still risk for sub 200-period EMA moves, but sustained weakness is not easy and the downside is well protected. We have talked about the multiple support levels that we have on the downside, especially starting from the 38.2% Fibonacci of the last leg up. But once again, we have major events coming up that could determine the trajectory of the index. So let's round things off with what's ahead. You have US CPI inflation, which dominates Wednesday's calendar. The last figures had shown a reacceleration in headline CPI to 3.2% in July, but a downtick in the more persistent core at 4.7%. Chair Powell said that inflation is still too high a few weeks ago in Jackson Hole, and has kept the door open, of course, to more hikes. That's essentially the last major data point from an increasingly data-dependent Fed as it approaches the end of its tightening cycle, or is already there. Of course, markets expect a hold at the next meeting, but there is less convictions around what's next, although still believe that that's the end of the road, the current level that we are now. Then on Thursday, we have the European Central Bank. It has delivered 425 basis points of hikes during this tightening cycle that started in July of 2022, but President Lagarde recently opened the door to a pause at this upcoming meeting. There is high uncertainty, however. On the one hand, we have inflation moderating but remaining elevated at 5.3%, both core and headline, but is high and far from the 2% target. And then there are economic concerns. We've seen from a series of poor data points, PMIs, GDP growth from the euro area and its main economic engine, the German economy, which is sputtering. And the EU Commission this week released updated GDP projections, which show a 0.4 contraction for the German economy this year and 0.8% expansion for the euro area, which is much lower than the previous update. Earlier on Thursday, we expect Australia employment data. The labour market has shown signs of cooling, and the RBA stood pat on rates last week, but kept more moves in place. So an important report there as well. That's pretty much it from me for today. We will talk again on Thursday, and we'll also cover the outcome of the ECB decision. Thank you for joining me.